Welcome back to the portfolio, everyone. And in this video, we're going over 6 stocks you should keep your eye on this week. On this list today, we have a combination of some dividend-paying stocks and some high-growth stocks. We have companies from all different sectors of the market, and they all have some major news event coming out over the next few days, which may have an impact on their share price. We have some solid blue-chip dividend-paying stocks that have been around for a long period of time, as well as some other low-yield, fast dividend growth stocks in this list as well. So every single Sunday, we go over different stocks you should keep your eye on over the upcoming week. And because every single week in the market, there's some big events, there's earnings reports, and there's other milestones coming out, we always like to do an update every single Sunday on this channel. So please hit that subscribe button and don't miss a weekly update. And as you may know, I am the Gen Z investor, and we post about the stock market every single day on this channel. We go over different stocks you can buy, overall stock market performance, and of course, we're going over any major stock market news or headline event. Nvidia is the first stock on this list today, ticker symbol NVDA, currently being traded at $522 a share. Over the past month, shares are down almost 9%, but on the 1-year chart, this company has been on fire and they are up over 200% in the past 12 months. As of late, they have seen a pullback away from their 52-week high, and this company is currently being traded at a $322 billion market cap. And why we have to keep our eye on Nvidia this week is because they are hosting their GTC, which is the GPU Technology Conference, and overall, GPU is growing in appeal. The overall industry is growing at a very fast rate, and this just has led to a lot of popularity surrounding this event, where Nvidia itself is going to, of course, introduce new products, overall expansion plans, and the overall growth expectation for this industry, and it's going to be a lot of fun to watch, and I really do believe they may be able to boost investor confidence in the company. They're also going to talk about their most recent acquisition. Nvidia plunked down $42 billion to acquire ARM for its CPUs. This was a major acquisition in the industry, and I'm sure we're going to get more news coming from this as well during this event. So that is kind of the reason why Nvidia should be on your watch list this week. This company has been on fire, nice rapid growing revenue year over year, which of course is what led to this large drive up in share price. They operate in an industry that is only growing year over year, and I believe this company will have a lot of room for expansion moving forward. Although this company is, of course, mainly a growth stock, they were up 200% share price growth this year alone, but they also do pay out a very tiny dividend, yielding 0.12%, which is almost nothing, 7% payout ratio from earnings, and a 5-year dividend growth rate of over 13% averaged over the past 5 years. And their dividend safety rating comes in at 89. This just represents a very safe dividend, very unlikely to be cut anytime soon, which of course, when you're only paying out 7% of your earnings and yielding 0.12%, that is kind of realistic to expect. The second company on our list today is Domino's Pizza, ticker symbol DPZ, currently at $433 a share. So why Domino's is attractive this week is because they're reporting their latest earnings. From their last earnings report, they beat on both earnings and revenue expectations. And on this latest upcoming quarterly results we're going to get this week, we're expecting to see revenue of $955 million and earnings per share of $2.77. So this would be a very interesting week for Domino's. This company has been climbing. They are up 7% on the month and up over 79% over the past year, a $17 billion market cap. Domino's is interesting. A lot of mom and pop small pizza stores were forced to shut down during the pandemic because they didn't have the online infrastructure in order to sustain and actually sell their products through mobile devices and computers. And of course, they didn't have the delivery infrastructure to distribute their goods. But Domino's has all that, so they remained operational for a very large part of the pandemic. And it'll be interesting to see how this company has performed. So their current yield is very low, once again, at 0.72%. Like I mentioned, this is mainly a growth stock. You don't really buy into a company like Domino's or Nvidia for the current dividend yield. They're paying out around 24% of their earnings in the form of a dividend, and they've been growing that dividend on average of over 21% per year over the past 5 years. Stock number 3 to keep your eye on this week is the e-commerce giant Amazon, currently at $3,125 a share. Amazon may be at an attractive price point right now. They're down over 11.5% on the 1-month chart. They've seen a pullback of over $400 per share from their 52-week high. And their market cap has seen a big decline because of the share price. So this retail giant, this e-commerce platform that is growing at an insane rate, you can see here, has seen a kind of a pullback away from this 52-week high over the past few weeks. They are up 82% over the past year, but they made the announcement that in the next coming weeks, Amazon Prime Day is expected to come out on October 13th and 14th, and this is a huge event for the company. They bring in extreme amounts of revenue over these 2 days, and what this does is Amazon basically created their own holiday. Of course, there's different deals and headlines and of course events going on the platform during this time, but they created their own holiday. They're doing this before the election. They're doing this now at a time where people may not be allowed to actually go into packed malls to shop for holiday gifts, and Amazon may become the go-to holiday gift marketplace. So this Prime Day event, if investors and actual individuals decide to spend money now, and rather than waiting in line at big packed stores in the future, this Prime Day may be a huge event. So getting Amazon on a small dip of over 11% in the past month may be at a nice price point to get into before we see Prime Day news come out. As we know, Amazon has been on fire, total revenue growing at an extremely fast rate. In 2015, they posted $107 billion of total revenue, and in 2019, $280 billion, up in the past 12 months to $321 billion in total revenue. Stock number 4 is Costco. Costco is interesting this week because they are actually announcing their latest sales report. So if we go to their investors relation tab, you can see here their upcoming event coming out this week is their numbers for their September sales. So they release their sales numbers at the end of every month, and this week we're seeing how they performed in September. So with cases spiking in the pandemic and the fear of another shutdown, people may be once again hoarding goods, buying more than they need at the current moment in time, and buying extra to make sure they have everything they need at home. So Costco's interesting right now. They're up 24% over the past 12 months, and this company has been around for a decent amount of time and up over 143% over the past 5 years. They currently have a market cap of $156 billion and yield 0.79%. So Costco, if we take a look at that dividend yield, the current yield of less than 0.8%, a payout ratio of only 29% of their earnings, and they've grown their dividend at a rate of over 14% on average over the past 5 years, which is great to see. And because they have such a low payout ratio, sustainable operations that continue to grow year over year, their dividend safety rating comes in at 99, which is the highest dividend safety rating possible, which just represents Costco as a safe dividend company to hold. Although that current yield isn't very high, they have done a nice job of growing their dividend at a fast rate each and every year. Stock number 5 on the list today is kind of a more speculative company. Beyond Meat, ticker symbol BYND. This is a company we've actually never talked about on the channel. You can see a lot of share price volatility with this stock. Huge up and down swings over the past year. They are up 16% and trading very close to their 52-week high right now. So this is interesting. The company currently has a market cap of $10 billion. And why we have to watch this company right now is because they are actually getting a massive expansion from Walmart. Walmart announced that they are expanding Beyond Meat products into 2,400 stores. That's huge for this company. So now they have a total of 112,000 retail locations in over 85 countries selling their products. So this is very interesting. This Walmart expansion, originally Walmart had Beyond Meat products in 800 stores, and now they're planning to expand that, triple that amount, and up to 2,400 Walmarts across the country. So it's big news for the company. That's huge potential sales growth, getting their products in front of more people than they already are. And overall, Beyond Meat right now is the leader in that industry, in that like specialty food niche. So it'll be very interesting to see how this company performs. If we take a look at their income statement, very small revenue numbers, 32 million, 87 million. Then in 2019, we saw an insane jump to close to 300 million. And in the past 12 months, they've posted over $400 million of total revenue. Moving on to the final stock to take a look at this week. This is ticker symbol PAYX, Paychex. So this company is reporting their earnings this week, which is why we're keeping an eye on them right now. They're down 4.7% over the past year, and over the past 5 years, they're up 66%. So this is the small to medium-sized business payroll and HR service, and why this company's earnings is very interesting to follow is because they kind of give a picture of how the overall small business and medium-sized business industry is performing over this past quarter. They have over 350,000 small businesses using their platform. So once their earnings report come out, we're going to kind of get a sense of how the overall small to medium-sized business has been improving over this quarter compared to Q2 of 2020. So they have seen revenue growth year over year, nice upward trend, consistent revenue growth each and every year, which is nice to see. They do pay out a dividend, currently yielding 3%, but they have a very high payout ratio from their latest earnings report, putting that payout ratio of 90% of their earnings. And they have a 5-year dividend growth rate of over 10% per year. And if we take a look, their dividend safety score is considered safe, coming in at 61. So those were 6 stocks you should keep your eye on this week. We have a lot of variety on this list today, companies from different sectors of the market. We have a lot of low yield but high growth stocks on this list today. And let me know in the comments if you like any of these companies, and we'll be adding them to your watch list for the upcoming week. Thank you for tuning in. I am the Gen Z Investor, and I will see you in tomorrow's video.